Hello everyone, today's video is all about business asset disposal relief, formerly known as entrepreneurs relief until the budget of 2020 when its name was changed. But in essence, this is the valuable capital gains tax break which you receive when you sell business assets. So let's look at shares. So you're an entrepreneur, you have shares in your own business and you are looking to exit. So if you sold those shares, what you want to try and do is make sure that you lock in this business asset disposal relief rate, which is 10%, so 10% capital gains tax instead of the default capital gains tax position on the sale of shares, which is 20%, so half of what the tax bill would otherwise be. Now, unfortunately, when they had the rebrand, as it were, of Entrepreneurs Relief to call it Business Asset Disposal Relief, not only did they change the name, but they also reduced how much gain you could get at and pay just 10% tax. Used to be £10 million of gain. It was like a lifetime clock. Didn't have to be on one transaction. Now it's gone right down to £1 million. But even so, you sell out your business for £1 million and you're only going to pay 10% on the gain. So if you started it from scratch, that is 100 grand of tax that you'd pay instead of the default 200 grand, i.e. 20%. So let's just dive in, have a look at some of the rules, some of the pitfalls to be wary of. So business asset disposal relief, forgive me if I just keep referring to it as entrepreneurs relief. That's what it's been known for like 13, 14 years, but it's the same thing. But essentially, on those shares, you have to hold them for 2 years before you sell the shares. So for those 2 years, immediately before you sell them, you have to have been an employee or an office holder, i.e. shareholder, i.e. director or secretary. That's what an office holder means. And which you would, if it's your business that you're selling, yes, that would obviously apply. However, there are some pitfalls. I'll come and talk to those later on. The nature of the company that you're selling has to be a trading company. It cannot be an investment company that exists primarily for the function of investing in assets, like a property investment business, property rental business. So it has to be a trading company or the holding company of a trading group. So let's say you've got a company above your trading company to hold the hold the shares of the trading company. And I've done separate videos on the benefits of having a holding company. If you're selling the shares in this holdco, the top co, that can still qualify as long as it's owning shares in a trading group. So you have to look at the round and say, well, even though the top company's not doing anything in its own right other than owning shares in the bottom co and any others are trading, well, that qualifies, so that's fine. So let's plow through these rules. What else? So it's got to be what they call your personal company. Now, personal company means you have to have at least 5% of both the shares and the voting rights. Okay? And at least 5% of either profits on a distribution or assets on a winding up or disposal proceeds if the company is sold. Okay, so that's important. So that's actually a fairly new addition to the rules, because for years it was all about, look, you've got to have 5% of the shares and you've got to have 5% of the votes. So often what happened, husband and wife companies, one of the spouse would become a shareholder, but they wouldn't necessarily have the full rights attaching to the shares, particularly with regards to equity rights, assets on a winding up or disposal proceeds at the back end. And HMRC said, look, there's a lot of people just putting spouses on as shareholders, not really involved in the business. So the way that was being done, they didn't like it, so they changed the rules. So now there has to be, full rights attaching to these shares if you want to spread the capital gains. Because obviously a prime planning idea is to say, well, look, if you're only going to get £1 million at 10% tax, and let's say you're going to sell for 2 million, then why don't you put your spouse on as a shareholder? Because they've got £1 million as well. So each person, it's the £1,000,000 attaches to the individual, not the company. So it's in that scenario, that's how you would extend, if you will, the amount of 10% tax available by having a spouse on. But you've got to be careful how you do that in terms of the shares and the rights attaching to those shares that you give to the spouse. So basically, 5% full rights on the shares. Also, if for whatever reason your 5% gets diluted because the company may issue more shares, for whatever reason, to attract investment or otherwise, since your original investment, you may dip from 5% below. There is a rule that says all is not lost. You could still claim business asset disposal relief if you do certain things. And it's basically an election to treat those shares that you had as if you'd sold them and immediately reacquired them the day before the new shares were issued. But something to think about. If you're on the cusp of that 5%, let's say you're not, say, the main person in the business, you're not 50% or 100% shareholder, but you are a minority shareholder, but still would qualify for this business asset disposal relief. But if your 5% drops and it gets diluted, potentially you won't, but there are things that you can do to ensure that you still do qualify. So just think about that if you're in that position where you are close to the 5%. Okay, other things to think about: EMI share options. Normally, and what we've just said, you have to hold these shares for 2 years before this applies. It used to be a year, by the way. Then they changed the rules last year. They said, no, we want to double the period. So you've got to hold the shares for 2 years in order to get this favorable tax rate. Now, if you've got a share option, if you're granted EMI share options, Enterprise Management Incentive shares, what tends to happen on these is that you exercise your option at the point that the company is sold. So in effect, you buy and sell your shares on the same day. So you actually have your time of owning the shares is minutes or hours. However, the HMRC are fairly pragmatic on this, and they say, look, we appreciate the fact that you've got these share options, which you may only ever exercise at the point of sale. So in effect, you buying in and selling out on the same day. So they say the 2-year clock only applies not from when you actually own the shares, but from when you were granted the option in the shares. So as long as your option is 2 years or more old, then when you exercise the option, that will qualify for the entrepreneur's relief, for the business asset disposal relief. So that's something to bear in mind if you are an option holder of EMI shares, which a lot of people are. So certain pitfalls to watch out for. The main pitfall is what I've seen from experience over the years is when shareholders who are directors come off the register as a director. Let's say, for example, a company is being bought out by a third party, and they say, look, we would like a few of you to stay on as employees going forward, and often that'll be part of the deal, because to get your full consideration for the share sale, they say that the acquiring company will say, look, we want key individuals to stick around. But let's say there's a matriarch or a patriarch who is looking to exit completely, and the buyer might say, look, we don't care about that individual or individuals. It's the next generation down that we want. So no room in our enterprise going forward for Ma or Pa, but that's fine because they're looking to get out anyway, not a problem. But often what they will do is they will cease to be directors before the share sale, often a few weeks or a few months. Not only will they cease to be directors, but they'll come off the payroll as well. So they won't even be employees. But they're thinking, well, that's not a problem because in a few months we're going to sell out for £1 million or whatever and go off into the sunset, and a few quid goes to the next generation as well, and they could continue to work in the buyer for a while. But that totally negates the availability of this business asset disposal relief, because you have to have been an employee or office holder immediately in the 2 years before. 2 years before the sale. So if you come off too soon, that wipes it out. And it's very difficult to convince HMRC otherwise. I've seen people try and say, look, we were de facto directors, even though we came off statutorily, we came off a company's house because of the pending acquisition. We still attended board meetings. Here's some emails to prove that we were still involved in the decision making. That's a tough ask to try and convince HMRC of that. Everything hinges on the facts, but the tip of the day is don't come off as a director or an employee until you've actually sold the shares in the company to the buyer, and then come off. Or if you do come off as a director, at least stay on as an employee pre-sale. For goodness sake, don't jeopardize not getting this valuable relief. And then the other one, like I said, is the shares, issuing shares to family members to spread the relief around. So everyone's got £1 million each, putting on the spouse, putting on family members, doing it in the right way, not giving them voting rights, just giving them a right to dividends. I've seen that many times. But that won't work because the rules say they have to be full right shares. So, don't just say, oh, we'll give them a certain class of shares to the wife and pay her a dividend, but she can't vote, she can't have any say in the company or rights on an equity payout. No, she needs to have, or he needs to have full rights on those shares. So just a few things to watch out for on business asset disposal relief, with the new name for what we all lovingly refer to as entrepreneurs relief, but it's only on the first million or a million, the first million that you accumulate on your business disposals. You could take you one or several to get there, or you could blow it in the first one, doesn't matter, but the point is you only get the 10% on £1 million. So do bear that in mind. But like I said, family members, if it's done in the right way, often that would work, particularly in terms of spouses, because you transfer assets tax-free to spouse. Difficult to add on other family members when it's a mature business and we're down the line and we're close to selling. You need to really think hard about that. But yes, if you like this video on business asset disposal relief, please do subscribe right there, and I will see you soon.